Good morning, everyone. On behalf of Vascon Engineers, one of the leading construction and engineering companies, I welcome all the participants for taking out their time to participate in our earnings call for the third quarter and 9 months of FY18. Joining me on this call is Mr. Rajesh Mhatre, CEO of Real Estate, Mr. D. Santanam, our CFO, Mr. M. Krishnamurthy, our Chief Compliance Officer, and Stellar Investor Relations, our advisors for investor relations. The investor presentation for 9 months FY18 has been uploaded on the exchanges, and I believe you would have gone through the same. As discussed during our previous earnings call, we have made sincere efforts to reinvent the company and are geared up to scale new heights. For the benefit of the audience who are new to Vascon, we have simplified the company's business focus into 3 buckets: EPC, real estate, and assets for sale. We are working towards enhancing the efficiency of all these buckets. In bucket 1, we have our EPC business, which is currently having a total order book of 901 crores. The third-party order book is 668 crores and 233 crores are internal orders from our real estate division. In bucket 2, we have the real estate development business, where we will be primarily focusing on launching affordable housing projects, including the launch of the remaining phases of Forest County project in Kharadi and relaunching the Windermere Premium project in Koregaon Park. In bucket 3, we have the non-core investments such as the commercial property in Mumbai, hotel in Goa, and various other identified assets which we are looking to monetize as we go forward. Our focus for growth in future would be clearly the EPC business and the real estate development primarily in affordable housing space. We have senior and experienced personnel looking at the progress in all the 3 buckets, with the management team working hands-on with them. Before I elaborate more on the 3 buckets, let me highlight that for a better understanding and clarity on the performance of our EPC and real estate divisions, we have provided the performance of both these divisions separately in the investor presentation. We have also taken the initiative to report the internal order book for our EPC division from the real estate launches for this quarter. Before I touch upon each segment in detail, I would share the EPC and real estate business performance in brief for the 9-month period of FY18. Please note that as an accounting practice currently, internal orders of EPC forms a part of real estate. During 9 months of FY18, EPC business recorded a revenue of 194 crores with an EBITDA margin of 14%. In real estate, the company recorded a revenue of 98 crores with an EBITDA of about 3%. I will now provide you the update on the EPC business. Our current order book is 668 crores from third party and another 233 crores of internal orders. We have till date in FY18 received external order inflow of 370 crores, which includes 230 odd crores of low-cost affordable housing in Andhra Pradesh. Internal orders of 233 crores includes orders of our real estate launches comprising of Platinum Square, Windermere and Forest Edge. We have around 1,000 crores of orders in pipeline to be procured in the next 8 to 12 months, which is a mix of both private and government orders. Moving on to real estate, under the able supervision of Mr. Rajesh Mhatre, we have successfully launched and fully sold phase 2 of Platinum Square, an ultra-modern luxury boutique office, and also Forest Edge, which is a residential project of 80 units. As said earlier, we will primarily be focusing on launches of affordable and low-cost housing projects in the future, as our target customer segment will be self-employed and low-salaried personnel with fast-moving product mix of studios, 1 BHK and 2 BHK apartments. The strategy is to generate better cash flow in each project while liquidating significant inventory at the launch of the project. We have identified a couple of land parcels for affordable housing project launches in Pune. One of the parcels is in Katvi, which is owned by us, with a potential of about 0.5 to 0.6 million square feet of developable space. We expect to launch this project in Q1 of the coming year, as we are currently waiting for a few approvals. The other land parcel is also in Talegaon, where we have a joint development agreement with the landowner. The total developable area there will be about 1.2 million square feet. Moving on to our third bucket, which is the liquidation of non-core assets. We are aggressively looking to liquidate non-core assets and use the proceeds for the growth of both our EPC and real estate division. The cash flow generated till date will be utilized towards repaying high interest-bearing debt and as working capital for our ongoing projects. With regards to our strategy of moving out of loss-making services division in our subsidiary GMP Technical Solutions, we have sold this division in November 2017 for a consideration of 18 crores. We are continuing with the profitable manufacturing business of the subsidiary. Moving on to the financials. We have made sincere efforts to optimize costs across all business segments and strengthen our balance sheet. During the year, we have been assigned a stable rating of SMERA BBB- for companies' long-term fund-based facilities and a SMERA A3 for companies' short-term non-fund-based facilities. This will help us in enhancing our working capital limits and in effectively reducing our borrowing costs. During the 9 months for FY18, the company reported a total income of Rs 239 crores as against 199 crores in the 9 months of FY17. EBITDA for the 9 months FY18 was at Rs 26 crores as compared to 32 crores in the previous year. Profit after tax is 5.5 crores for the current year as compared to 3.6 crores in the previous year. The company did new sale bookings of 1.9 lakh square feet, amounting to a total sales value of 140 crores in the 9 months of FY18 in our real estate divisions. And against new sale bookings of 1 lakh square feet for a total sale value of 60 crores for the full financial year 2017. New bookings in the 9 months FY18 does not include figures for Forest Edge, which was launched in Q4 and has also done significant sales. With this, we can now open the floor for question and answers. Thank you very much.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. We take the first question from the line of Vipul Shah from AB Capital. Please go ahead.
Hi, Santosh. Basically, 2 questions. The first question, I actually want to take a step back, and in the beginning of the year in a conference call, we said that FY18, we should be doing around 500 crores of new EPC order intake, and we will be launching 4 new real estate projects in this year. So you have given some of the details in your opening speech, but I want to hear out from you that where we are in that, and also how do we look at next year?
So, hi Vipul. Out of the 500 crores we had hoped to, bag third-party orders, we have already bagged 370 crores this year. Another 160 crores of orders is at a final stage of negotiation with our clients, and hopefully we will be able to announce those good news shortly. So I think we are on track to achieve more than 500 crore third-party order intake. Also, parallelly, we have got a 200 plus crore internal order intake. So I think our order book is only, on the EPC side, the order book is only going upwards and strengthening. Next year, hopefully, we should, as I said, we have 1,000 crores of order pipeline which we are working on. Hopefully, we will definitely achieve more than 500 crores as our target for the next financial year as third-party EPC order intake. With our BG limits, opening up and our banking support getting better, the challenges to bag orders are reducing, and I think we should definitely be poised to do much better in terms of order intake in EPC next year. In terms of real estate, yes, we had mentioned 4 launches. The 4 launches we were talking about were Platinum Square, Forest Edge, Windermere, and Katwe low-cost housing. I'll leave it to Rajesh to update you on the status of each of these launches. Rajesh, are you there?
Yeah. See, as far as the real estate launches are concerned, we are on track. We have already done a couple of launches. To start with, Platinum Square was the first launch, followed by Forest Edge. We would be launching Windermere. Windermere was supposed to be launched in February. In fact, it's getting delayed, by another maybe 20 odd days. We would be launching Windermere in the first week of March, which will be followed by Katvi. Katvi was supposed to be launched by March and April start. Some couple of approvals are getting delayed, due to which we have to postpone it by a month or two. But as far as real estate launches are concerned, yes, we are on track, and we should be launching them as mentioned earlier this year.
So Rajesh, in terms of launches, it's good, but how is it in terms of the Platinum Square which you spoke about and the Forest Edge which we have done in the fourth quarter? How has been the sales and the collection?
With regards to Platinum Square, we were positively surprised. That was the first launch of the real estate team. It is by far one of the most premium boutique office projects in Pune, Viman Nagar. We managed to sell it completely. And the total size of that launch was close to 50 odd crores. Again, Forest Edge, which we launched just recently. Again, in this tough market, we launched this particular project at a premium to the prevailing market price, and still we managed to sell off the entire project successfully. That was close to 55 odd crores. So again, these two set of launches were, one was a boutique office, second was aspirational segment, and now we, in a completely focused manner, have shifted our gears to Windermere, because Windermere is a challenge for us. It's the ultra luxury project, one of the best projects you can have in Pune, and we are very, very confident the way the project has shaped up, and the buzz which is around the project. The strategies which we had implemented for this particular project are panning out successfully, and we are hoping that we should be having this relaunch will also be a successful relaunch.
And Rajesh, in terms of the collection from Platinum Square and Forest Edge?
The collections, how
you can give me a broad idea, like I may not need the exact number, but how has been the collection from Platinum Square and Forest Edge?
Puneet, can you just tell us exactly what are the collections for this particular project? I won't have it handy. See, the Platinum Square from phase 1 and phase 2 of the total collectibles, I think the only outstanding collections would be 30 odd crores. So from phase 1 and phase 2, the total collections. In fact, Puneet, can you just guide us to the collection number? If you have
basically, Platinum Square phase 1 is completed. So I think there's hardly any, not much of collection left over there. Phase 2 is about 60-70% completed, and the collections from the customers are happening as per the stages. So there's no issue because it's fully sold out. So the collection is happening as per the stages committed in the agreement. In terms of Forest Edge, we have a total sale of 65 odd crores, out of which 20% is due and collected. So to the tune of 8 crores is collected. The balance will get collected as the stages get achieved over the next 12 months or so. 12 to 20.
And Rajesh, so how's the status of launches in FY19? So let's say if we do Katvi around April end or May, let's say we do it in May. After that, how's the pipeline and what are we really planning?
See, for the year, in fact, we have done the first tower of Forest Edge. In Forest Edge, we have one more tower, and in Forest County, we have two more towers. Okay, all are exactly similar, 80 units each. So we should be having these launches, spread across. Maybe the next launch of the next tower of Forest Edge would be somewhere around August, and maybe Diwali we will be launching the other two towers of the Forest County. The total sellable in terms of square feet, 3 lakh square feet, 3,60,000, 80,000 square feet each of all these four towers. After that, we have the launch of the larger affordable land parcel, roughly 1.5 million square feet, again in Talegaon, which we are hoping that we would launch the first phase of that particular launch somewhere around Diwali. Post that, we also have, Tulips Phase 3, one of our projects in Coimbatore, a small project, 2 lakh square feet, which will be launching in Coimbatore. And then we have an affordable housing launch, which is a large project in Madurai. So first phase of that launch should happen. Meanwhile, we are also in discussions, for various other joint ventures. So depending upon, what fits, because initially you could easily plan this kind of launches. Presently, unless you have all the approvals in hand, you have RERA registrations, unless you have everything in place, it becomes, difficult for us, to go ahead with that particular launch. So that adds the only bit of uncertainty, to the launches. But yes, we have a very, very strong launch pipeline, if you want to say. At least for the next one and a half years, we have a very strong launch pipeline.
If I'm allowed one last question, I was looking at the presentation and there is a slide where we have given the EPC and the real estate breakup in terms of revenue and EBIT and expenses. If you can just explain to me, because this doesn't matches with the statutory segmental disclosure also. And if you can just explain me the basis in which you have prepared this.
Yeah, so see, this is the first time we've actually attempted to do this exercise and share it with the investors, because I think it was a high time we sort of measured ourselves as 2 separate divisions. We've been talking about 3 buckets, and then we've had a separate real estate team with a new real estate CEO. So we thought it's high time we start measuring our own performances division-wise internally and sharing this with the investors. Now, the basis for arriving at this, it's a derived, I would say it's a derived P&L statement which is derived from the balance sheet, statutory balance sheet in the first place. There are only 2, from the top line perspective, there are 2 additions. One, in the real estate P&L, the statutory balance sheet doesn't permit you to take the top line of a project in Ajanta, which is our Forest County project, because that is in a partnership company, and therefore the top line normally doesn't come to our balance sheet. For purpose of this presentation, about 30 crores of our share of top line from Forest County or Forest Edge, the Ajanta company has been taken into this presentation. And also, because we are segregating this internal order book from the real estate division to the EPC, we've taken out the construction or the construction expense as an additional order from the real estate division to the EPC division. So the EPC division has done about 160 odd crores in 3 years from third party, and an added 37 crores has been executed for our internal real estate team. So we have added that to the EPC top line. So these are the 2, changes we've done from the statutory balance sheet to reflect the reality in terms of 2 separate divisions. Then going down in terms of costs, the direct costs are quite, clearly available to us from our accounting system as to what belongs to which project, and so that's not a challenge at all. The indirect costs, we've actually put down the list of employees and divided clearly which employees clearly belong to the real estate function, which employees are clearly working in the EPC function, and the third set of employees, the corporate overhead employees who are common to both. And we've divided the costs of the common employees, equally between the 2 divisions. And the direct employees which are belonging to those divisions, we have kept their costs in those divisions. And the last part is the depreciation. I think again in depreciation, the construction equipment depreciation has been calculated separately and loaded purely on the EPC division. Any assets that we own in terms of real estate assets, like a Caledonia or a project, some of them have been, the depreciation of those have been kept on the real estate division. And other common depreciations of furniture and computers and stuff like that are again divided equally between the 2. So I think this has been the basis of arriving at these 2 separate P&Ls, just to give us, so that we are able to track our own performance as 2 separate.
Oh, this is definitely more helpful, dividing the 2 P&L, and thanks for the answer.
Sure, we'll try and get, probably continue this practice quarter on quarter and see so that we're able to compare the performances quarter on quarter of each division.
Thank you.
Thank you. We take the next question from the line of Hitesh Arora from HA Investments. Please go ahead.
Good morning, sir. Congratulations on the good numbers. My first question is, as we have gone through the presentation, the EBITDA margin in the real estate is very low, say around 3%. So can you explain the reason and what's the strategy going forward to improve the margins?
So I'll just explain on behalf of Rajesh over here. See, the simple answer to that, the gross profit in real estate, we've done about 100 crores. The gross profit is in the range of 27%. This should probably be in the range of 30, which will happen probably as the new projects unfold. But the real reason for EBITDA being so low is purely because this is the first year that we've taken in the new real estate team, and the costs, the overhead costs have added up this year, and the launches have happened. The effect of these launches on our top line will only pan out over the next year or two. So I think that's when you'll start seeing the EBITDA go up, because this year it's very simple. It's the overhead that is, eating up that margin.
Okay. My next question is on to our EPC division. We have of around capacity of around 8 million square feet per annum. So are we bidding for any new projects is there any new order pipeline, and what will be our run rate in the coming years?
Yes, so as I said, we are at a very advanced stage of closing out orders worth about 160 crores. Hopefully, I should have some good news to share in the coming few days. Other than that, we are continuously bidding. There were, as I explained in the previous quarter as well, there still remains a slight restriction in terms of the BG limits and the BG margins available to us. But our discussions with the banks are at a very advanced stage. Once our rating has improved and our compliances have been in order for a long time now, so the banks are looking at us, in a much more amicable manner. And SBI, who is our primary banker, is now, at the last stage of renewing with much better terms our facility with them, and also assessing us for higher BG limits. Once that assessment is out, we will then approach a few other banks, a couple of other banks to form a part of the consortium and give us those BG limits. So I think this financial exercise has been taking a little bit of time over the last 2-3 months, but it is moving very well, and pretty soon we should have those limits in place. The reason I emphasize on that is once those limits are in place, our ability to bid for multiple projects at a time increases. Right now we are picking and choosing, a little bit, because our BG limits are not in abundance for us to bid for every project that we would like to try and bid for. But having said that, it's a very short term. I think we are almost at the end of the tunnel as far as this banking issue is concerned. It should be over definitely before March. So next year we will definitely have a higher target of order booking for ourselves.
And how much revenue potential we can see in coming quarters and in FY19?
So hopefully, I wouldn't want to speculate on numbers specifically, but Q4 will definitely look better than the average of, the first 3 quarters. Or in fact, if Q3 was better than Q2, Q4 looks much better than Q3 in terms of top line. So again, I wouldn't want to put a number to it, but it will definitely be more than a linear growth.
Okay. So next question is related to our subsidiary GMP. What will the performance for our 9 months for this quarter, and what will be our expected FY19 revenue expectation after the exit from our service division?
Yeah, so I think we will not talk about the numbers of the service division that will hit the balance sheet this year, because I think halfway in the year we've got rid of it. But in terms of the profitable manufacturing division, we've done in 9 months we've done 118 crore of top line, and the EBITDA is about 7.5%. As this top line increases, this EBITDA would also quite clearly increase. So I think, again, I wouldn't want to put a number to it, but again, the growth in fourth quarter is, is more than, or rather what we'll achieve in the fourth quarter would be more than what we've achieved as an average in the last 3 quarters. So you could, sort of extrapolate and arrive at a number.
Okay. So last question from my end. What is the potential cash flow we can expect to generate in FY19?
You mean from sale of non-core assets, or we generate cash flows from, of course,
from the core.
We're getting cash flows from live real estate projects as well. I think the more important cash flow that we want to focus on is the non-core assets, because those would directly help us as growth capital or capital to reduce debt. We have sold about 140 crores worth of real estate this year. We have collected close to 70 to 80 crores worth of money. Some of that is non-core old assets which were lying with us. So, yeah, I don't know exactly how to answer your question in terms of cash flow for FY19.
Okay. Thank you so much, sir.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. We take the next question from the line of Nandish Shah from Nirmal Bang. Please go ahead.
Hello. Sir, my question is regarding, are there any plans to raise funds?
We are constantly looking to raise short-term debt capital to maybe, roll over some of because we do have a working capital. Like, we have raised a little bit of capital from Edelweiss in the last couple of quarters and drawn down on that to complete our Windermere project. But on the other hand, we have also paid back a few other debts. So this process, I think, so when we launch Katvi, we would definitely, in the initial period, need a little bit of project funding, which we will try to raise specific to the project. But at the company level, we are not yet looking at any raise of capital.
Okay. And my second question is regarding the tax front. I guess in the September and in the December quarter, we have not paid, the effective tax rate has been 0 most. So, can you throw some light regarding, will we be paying any tax in Q4 or?
This is actually, we have huge amount of carry forward losses over the last 3 years.
Okay.
So I think primarily that is the reason, and also because now our by Ind AS, we don't reflect the tax that we pay in our Ajanta, which is a partnership project where we do have taxes, that used to come in our balance sheet as tax paid earlier. Now it doesn't come. So other than that, I think in all, we've merged all our other companies. They're all in Vascon, and in Vascon we have carry forward losses.
Yeah. Thanks, sir. I'm done with my questions. Thank you.
Thank you. Participants would like to ask questions. Please press star, then 1. We take the next question from the line of Abhilasha Satale from Dalal & Broacha. Please go ahead.
Yeah, sir, actually, what kind of investment we are looking into real estate over, say, FY19 when we are, starting the other 2 projects?
Yeah, you were not audible. One is what kind of investments we are looking in real estate, and the other part is?
So when we will start the other, you mentioned the 2 towers we will start. So what kind of investments we are looking for those? Like
for starting, the rest of the towers in Forest Edge, we're absolutely not looking for any investments. Forest County, any which way, is a very, very cash surplus project. We have sufficient cash flows as far as the launches of the next tower of Forest Edge and couple of towers in Forest County are concerned. With regards to, just to extend, I don't know whether you want to understand that, but for our affordable housing project in Katvi, in fact, yes, we would require, capital. We are in talks with banks for raising the short-term capital, but that is just a small project funding, not more than, 25 to 30 odd crores we are looking for the launch of that particular project.
Okay. Okay, fine. Thank you.
Thank you. Participants would like to ask questions. Please press star, then 1. We take the next question from the line of Kirit Gogri, an individual investor. Please go ahead.
Hi, thank you for taking my question. I have 2 questions. First is about what is the current consolidated debt as of today, And second is, what is the fixed cost of our real estate division on fully loaded basis? Because I understand you are still recruiting people, and by March you will have a full team in place. So after that, in FY19, what would be the total fixed cost of this particular division?
In terms of debt, at a consolidated level, we are at 290 crores. That includes the debt in GMP as well as all the debt in Vascon. And to answer your question regarding overheads or fixed costs in the real estate division, the bulk of the recruitment has happened. Very little bit of it continues to happen depending on project launches. In terms of numbers, I think we'll have to get back to you in terms of specific numbers, what exactly is the fixed cost.
Okay, thank you.
Yeah, sure.
Thank you. We take the next question from the line of Jigar Shroff from Financial Research Technologies. Please go ahead.
Sir, I had two questions. One is, what would be the consolidated debt at this point of time in the balance sheet and the rate of interest that we are paying, and how much has our rate of interest reduced after the rating upgrade we got? And the outlook on debt going ahead, I mean, does the company intend to be debt-free over the next 2-3 years?
Yeah, yes. So as I said, the consolidated debt stands at 290 crores. This includes 30 crores, 40 crores of debt in GMP, which is our subsidiary. The cost of funds has come down. Currently, on an average, on this debt, it is in the range of about 12%. It used to be a little bit more earlier. Now, after the rating, we have talked to SBI. The rate of interest that SBI would be charging us on our CC limit will definitely be coming down by a good amount. But the revised sanction from them is pending, which will happen anytime now. And so I think we will be looking at numbers, close to 10% in terms of the CC limit. But we will only know once the sanction comes in exactly.
So the consolidated rate is approximately 12%, which you expect to go down to 10% over the next couple of months on the...
Yes, so starting next year, I think the interest rate would be down. Unfortunately for us this year, even if the rate has been reducing, most of it has happened in the last quarter or the last 2 quarters. So in the first 2 quarters, we did have a higher rate. Next year, starting from March itself, we will be having a lower cost of borrowing, which will reflect definitely on our balance sheet. So yeah, you're right. Maybe starting next quarter, hopefully our average cost of borrowing should be lower from 12 to closer to 10.
Yeah, I think, sorry to interrupt, I think Santosh is talking about the cost of borrowing, of the working capital limits. Overall consolidated, I think we will need to come back because it is a...
it's consolidated, Rajesh, because so it's all on the 260 crore, including the NCDs that we have.
Achha, including the NCDs, okay. Yeah, NCDs are at a lower rate,
Yeah, that's right.
Yeah, so the 290 crores is a consolidated debt and current cost is about 12%, which you anticipate to go down to about 10% starting from FY19 onwards, right?
Right, that's the attempt, yeah. See, we do have the only high-cost loan we are currently carrying is one on Windermere, which is from Edelweiss.
Yeah.
So that we will also be definitely, bringing down those interests in one way or the other over the year. If not bringing down the entire debt itself, we will also work on bringing down the cost of borrowing for that project also. So yes, next year's target should be at least a couple of basis points lower.
And the outlook on debt going ahead, looking at the divestment of your non-core assets and also cash generated from existing businesses, over the next 2-3 years, does the company anticipate to become debt-free or something? I think that's the vision, right?
Yes, that is definitely the target.
Over the next 2-3 years.
Yes.
See, just to answer that question more elaborately, debt-free, the large chunk would come once, post the sell-off of GMP as a unit.
Yeah.
So we are in the process of doing that. It can happen in the next financial year or the next. But yes, we are focused on exiting out of GMP. That will bring significant cash flows and will keep our company on track to be debt-free. In the interim, yes, there would be certain project-based funding that would be required for those real estate launches, but those would be small project level debts that would be taken by the company. We are constantly looking forward for generating cash flows because there would be there is a growth capital that is required for tying up new joint ventures, starting up new projects, because it's not those good old days that you could easily launch a particular project. Now you need to have all the approvals in place, you need to have everything in place. So which also asks for that there is a significant investment upfront, because nowadays the government approvals are also not cheap. So there is certain level of investment that is required, just to keep the company and the project pipeline, the launches on track.
Now, so my follow-up question would be, what would the expected valuation of the GMP Putty division be now that you've sold off the Mumbai? Any ballpark figure which you would expect or something in terms of divestment?
So see, again, it's tough to speculate on a value, but what we can see, they've done 118 crores of top line this year in 9 months. So if you extrapolate this, and it's not on an average, so I think we should achieve more than 160, 170, close to 200. And next year, if we are able to grow at a 15-20% on top line, this EBITDA will definitely go upwards of 11 to 12%. So valuation from there, I think, is a matter of EBITDA multiples that the industry might give us. But I think that's where we're targeting the company internally to go next year.
So, what would be, any ballpark, what would you anticipate, something?
No, I don't think we can speculate on, because a lot of factors would be involved on specific valuation in terms of who's the suitor and what's the industry gearing towards. But what we can tell you is that we're focusing very specifically on ensuring that the performance of the company is improving quarter on quarter, and next year we would have left all the cancer behind and we'll be 100% running towards growth in both EBITDA and top line.
So FY19 GMP could be PAT positive, you mean?
Yes.
And how much is the loss, for in the first 9 months, any figure for GMP 9 months would be?
We haven't actually audited the balance sheet or done it, so I don't know the exact numbers. But of course, next quarter we will have to close out the balance sheet and clearly reveal.
Okay. Yeah. Any, vision statement that you would give? How do you see the company shaping up in terms of revenue, say in the medium term, say over the next 2, 3, 4 years, in terms of top line and profitability, sir, if you could shed some light on that.
I can only say that the worst is far behind us. We are at a point where we've been curing all the smaller niggles and, if I may say, some diseases that were there in the system. All of that is done. So really there is no, and the market is also looking good with all the infrastructure emphasis from this government. I'm sure, low-cost housing has been a buzzword which is slowly really catching up in terms of action on the ground. So with all of that happening and with our banking limits also getting better, I think, really speaking, there are no excuses or impediment to growth going forward. Again, whether it is a 15, 20, 25, 30% year-on-year growth, only time will tell. But definitely we will be looking for good growth in terms of both top line and bottom line. In both the EPC and the real estate. So in the real estate side, we are, as Rajesh said, we are talking already. We have a team that is looking at new land parcels in and around Pune and outskirts of Bombay for tying up new JVs in the low-cost housing real estate. And in terms of EPC, of course, we are bidding for whatever buildings across India which we think we would like to or be capable of building. So both these divisions over the next 2-3 years look extremely promising, extremely positive. And so any percentage of growth should not be a surprise, actually.
And in your land bank, sir, the land bank that you're holding, which is fully paid, I believe the biggest chunk or parcel of that, is it the Thane land parcel, sir? About 150 odd acres, I think it mentioned in one of the earlier con calls, sir, right?
That's right.
Yes.
What is the plan you have on that project, sir, on that land parcel?
So I think our answer remains consistent over the year whenever we've been asked about this. See, I think it is not yet crystallized or hot enough for us to give a specific target on what we will do on that land. It is definitely a gold mine lying with us. It is, 150 acres, out of which 50% belongs to us, so 75 acres of prime land just on the outskirts of Thane. It is not yet in the residential zone in terms of the DP plan. We are awaiting the next DP plan revision where we are expecting it hopefully to be classified as a developable land. And then a little bit of consolidation is needed on that land to make it contiguous and ready for launch, which would need a little bit of capital. So once the DP brings it into developable zone, we will then specifically look at that as a target how to really start the development on that. But it is safe to say that, for the next couple of years, I don't think numbers from that land parcel would be hitting our P&L or balance sheet.
Okay, sir. Thank you, sir. Thank you for taking my questions. Thank you.
Thank you. Participants would like to ask questions, please press star, then 1. Participants would like to ask questions, please press star, then 1. As there are no further questions from the participants, I would now like to hand the conference over to Dr. Santosh Sundararajan for closing comments.
Thank you everyone for participating, and we'll see you all again next quarter. Thank you.